friends. Now we're ready to talk about our personal lines as far as miscellaneous coverages. So this module is going to be covering a lot of miscellaneous things like flood and mobile homes and boats and those types of things. So I am actually going to turn the video off. So you'll see this here. I'll come back on the video and when I want to do an important point and at the end as well. So I'll go ahead and turn off the video and we'll go straight over to our PowerPoint presentation here. So what we're doing here is our personal lines, and it's flood, mobile home, boats, and personal umbrella. So again, I'm Tammy Grisso DeLaura, and my school is called Tammy DeLaura Insurance Educators. This course will not satisfy your pre-licensing requirements. It is used only as supplemental materials. Now, you are in the right place if you've been struggling with the property and casualty pre-licensing state exam and you really want this career change. You've taken self-study or classroom class and there's so much material and it's very hard to figure out what is important. So what I've done here is a streamlined approach to tell you what's important on the state test so you can learn the key points for each subject. Now, a little bit about myself. I've been in the insurance industry for over 30 years, and I've been teaching insurance classes for 27 years. I'm a subject matter expert for Pearson VUE, and I purchased several insurance agents in addition to owning this insurance school. So the reason why I'm telling you all this is so I can safely say that I am in the trenches with you guys. So when I give you examples, these are real life examples that I can bring to you that will hopefully stress that point so that you can pass the test. I'd love for you to follow me on Facebook and LinkedIn. I'm under Tammy DeLaura Insurance Educators. My motto is prepare, repetition, and confidence. Always repeating things over and over again. That's what you have to do for this class to get confidence. So let's inhale confidence and exhale doubt and get started, because the best time for new beginnings is right now. I have to put this disclaimer on all of my classes. It basically is saying that policy forms, insurance, things like that change constantly. So you do need to check with your state forms to make sure that the state forms are in compliance to what you need to know. Now, the first thing that we are going to talk about is the National Flood Insurance Program. So flood insurance is generally unavailable until the federal government became involved. So this happened in 1968. It's called the National Flood Insurance Program. The program is managed by the Federal Insurance Administration, which is a branch of FEMA, which is the Federal Emergency Management Agency. Now, unlike most of our insurance topics where we've talked about how they are state regulated, meaning that each state may be different with their auto form or their homeowner form. When it comes to flood is a federal program. So even though the states manage the insurance program, flood insurance is a federal program. So it is always a separate policy. It is excluded under the homeowner form, the dwelling form, the commercial form, fair plan, and coastal property forms, which we're going to talk about. Now, what are our programs? There are two types of flood insurance programs available, and that is your emergency program and your regular program. Now, remember when we talked in our homeowner and dwelling forms, how we had one deductible. So if there was a fire and the fire happened to be on the dwelling and personal property, the client only had to pay one deductible. But here in our flood world, something that is majorly different here is that both building and the contents have deductibles, and the deductibles apply separately, one for the building and one for the contents, whereas in your dwelling and homeowner policy, you had one deductible. Here is totally different. Now, your very first program is called your emergency program, and this is when a community applies to the NFIP and they are finalizing their flood insurance rates. So maybe they haven't done all their flood proofing and maybe they haven't done their mapping. So they will start out with the very basic limits. And the building limit is $35,000 and the contents limit is $10,000. And then they will go under the regular program. And so if you write flood insurance out there, this is the maximum that you can write for flood insurance. And the building is $250,000 and the contents is $100,000. So that would be your regular program. Now, who needs flood insurance? Basically, they want us to tell anybody that has a building that is walled and roofed and principally above the ground needs a flood policy. Now, what I will tell you is that flood covers building and contents. And there's a lot of things that are excluded. So when you think about flood, just really concentrate on the building and the contents. There are flood maps and zone determinations, and these maps are used to determine the rates and purchase requirements. Now, when it comes to what is available under flood, you can write homes, which are residential. You can write businesses, which are commercial. Now, your single family dwellings are the only buildings that can be insured on a replacement cost under a flood policy. So what is flood? Flood means an overflow of inland or tidal waters, unusual and rapid accumulation or runoff of surface waters from any source, mudslides caused by accumulation of water on the ground or underground, collapse of land. Flood insurance is a separate policy. Now, when it comes to sewer backup, remember in our property forms, like in our homeowners and dwelling forms, where we said flood and sewer backup and pump overflow is totally excluded. Well, with sewer backup and those types of coverages, you have to endorse that to the homeowner policy. Sewer backup is not covered under a flood policy. If this coverage is desired, it has to be under that homeowner policy. Now, there are some general rules for flood. Applications must be completed in full and accompanied by payment in full. Now, that is so important because it is the only policy that I can think of where they won't do a down payment. When it comes to flood insurance, they want the payment in full before it will go in effect. Partial payments are not permitted. There is a 30-day waiting period. So when you complete the application, the coverage won't be enforced for 30 days. Agents cannot bind flood insurance. If you're out there and you're used to binding your home insurance within your company's requirements and your auto insurance within your company's requirements, you cannot do that for flood. You will have to wait for them to tell you that it is okay and that the coverage is bound. You as an agent will not bind it. Now, even though it is a federal program, the rating, the claims handling process, and those types of things they will go under the Write Your Own program. And the Write Your Own program is really cool because the federal government realizes that they really cannot administer flood insurance. They're not an insurance company. So they have given this to the private insurance companies to sell flood through their companies. Now, there's no reason for you to shop flood because flood will always have the same rates because the FIA sets these rates. So unlike home insurance and dwelling insurance where companies come in and they compete against each other, you do not do that with flood insurance. The FIA has set the rates, eligibility requirements, and coverage limitations. Now, what happens, the participating company like an Allstate, Nationwide, State Farm, Travelers, whatever that company is, they will collect premiums and pay losses out of these premiums. Now, it's a win-win because if the amount of losses exceed the amount of premium collected, the FIA pays the difference. So you always go to these private insurance companies so they can write your home, their auto, and also the flood insurance. It will be on their paper, but again, the flood FIA definitely sets those rates. Some additional information you need to know about flood is, again, there are two deductibles, one for the building, one for the contents, totally different than in your homeowner and dwelling world. Agents do not bind coverage. Additional living expenses not on this policy. So therefore, if there is a flood, this policy, unlike the dwelling and the homeowner policy, will not pay for you to go to stay in a hotel while your property is being repaired. Because usually you're going to have some coverage coming from your homeowners, maybe a little bit of wind and hail, and that will have the additional living expenses on there. Now, property removed is 45 days, which is a little bit longer. So if you need to move your property, you'll have 45 days coverage, which remember in homeowners is 30 days coverage. DP1 is 5 days and DP2 and 3 is 30 days as well. But here you have 45-day coverage. Okay, so that is your flood. Now let's talk a little bit about watercraft and yacht insurance. Now remember in the homeowner world, we did talk about some boats. Okay, so if you remember over in the homeowner world, and I'm going to stop my screen here and I'm going to share the whiteboard with you. And just kind of put this in perspective as a review. So when it came to our homeowner policy, and we're talking about boats here, we had a section 1. Now remember, it is $1,500 for boats and their trailers. So if your client does not get a boat policy and that boat has a fire or a theft or a vandalism, then your homeowner policy could pay up to $1,500 for the boat, including the trailer. Now, under section 2, the homeowner liability would extend to boats, okay, but they had to be an outboard that is less than 25 horsepower. Okay, so 25 horsepower or less, let's put it like this, is 25 horsepower or less. That's the better way to do it. And then we had an inboard outboard, okay, and that had to be 50 horsepower or less. Okay, and then we had any type of sailboats. Okay, and whoops, these have to be 26 feet or less. And then any boat in storage. So this was kind of what we had with our homeowner world. Now, when it came to our dwelling world, we basically said, nope, not going to have any type of boat coverage. So no boat coverage here. Now, it will cover under your dwelling canoes and rowboats. Okay, so it does tell you that. But basically, you don't have any boat coverage except for canoes and rowboats. So that's just a review of what we learned. But of course, the best place to put a boat policy is going to be on on this boat policy. So when you're talking about the hull, what you're talking about is the boat itself. Now, under personal watercraft insurance or under personal boat insurance, when you go to get some boat insurance, it has to be used solely for private pleasure purposes. It's not something that you can charter out or transport people or property for a fee. You would have to get a different type of policy for that, not a personal boat policy. Now, coverage is excluded when the watercraft is used in an official race. This is a package policy. You have property and liability on an open peril basis. You can use this to insure boats under a specified length or under a maximum cash value. Losses can be paid out for boats ACV, actual cash value. If the boat is older, some companies will want actual cash value. If it's newer, they do replacement costs. Some companies will do a stated amount. So that's just some general information about your boats because different companies have different types of boat policies. One of the things that I would remember is, again, private, no chartering out. It is a package policy, and then know those exceptions on your homeowner and know that the dwelling form does not have boat coverage except for rowboats and canoes. Now, the second type of watercraft policy we're going to talk about is personal yacht insurance. And I call these like houses on the lake or a river or that type of thing. So it is, again, an ocean marine policy. It's a package of property and liability. It's open peril coverage so that everything is covered that's not excluded. Coverage is including for shoring, which can occur when the yacht is on the shore during bad weather or a windstorm. There is a layup warranty where you could get some premium reduction if you're not going to be using the yacht within a certain time period, like certain months, you may not be taking it out on the water. When it comes to these yachts, there is some navigational limits that defines where the yacht is permitted to operate. So losses that occur outside these limits will not be covered. Now, when it comes to hull, think of the boat itself. If you see protection and indemnity, this is your liability limit. So a lot of times they won't put liability limit 100,000, they'll put protection and indemnity. So this is your liability limit for your yacht. So think protection and indemnity, liability limit, and you should be good to go there. Now we're going to switch gears a little bit and talk about our mobile home policy. So we always talked about in our homeowner world, we talked about how we really want these mobile homes to be on mobile home policies, that some companies will let you put them on a homeowner policy. It'll have to be endorsed. It'll basically say this is a mobile home. You have some DP1s that a company may let you put it on the dwelling policy, the basic form. Most of your companies are going to say that has to be tied down, which means a foundation has to be around it. But again, most of your companies are going to go to where they say, hey, let's put these mobile homes on a mobile home policy. So mobile homes face unique exposures to loss, such as high winds and fire damage, as well as to collision or upset. Now, this is a package policy, just like your homeowner. It includes property and liability. Coverage is provided not only for the mobile home, but all equipment and accessories that are built into the unit, other structures, personal property, and loss of use. It looks just like your homeowner policy. Damage to the mobile home. Now, if you are going to be transporting it, you'll want to put this collision or upset endorsement on the mobile home. In other words, you're going to move it maybe to another piece of land, that type of thing. The liability coverage is very similar to the Section 2 of the homeowner policy. In other words, you have $100,000 per occurrence and $1,000 per person for MedPay. So it's very similar. Now, it really depends on the company that you're going to for these mobile home policies, and it depends on the age of the mobile home. Some companies will let you do a replacement cost, which means they won't depreciate the mobile home. Maybe like if it's 15 years or newer. I don't go by that because, again, you're going to be tested on mainly, you know, as far as it being a package policy and what it covers and collision or upset. So, and then some companies will say, no, this mobile home is maybe over 15 years or over 20 years. So we're going to do ACV. So it really just depends on the company guidelines. There will be premium credits for fire alarm systems and tie down credits. Remember, that's that foundation that goes around the mobile home. Now, this is really strange. Flood coverage is provided on the mobile home. It's the only policy that I can think of where flood is on the policy. So mobile home policies have flood. Isn't that crazy? Homeowner policies don't, commercial property policies don't, dwelling policies don't, but a mobile home does. Now, as far as money coverage, there is no money coverage on a mobile home policy. Just like in dwelling, there was no money coverage. Remember, in our homeowner policy, what do we have? $200 for money coverage, but there is no money coverage on your mobile home policy. And most mobile home policies have to be owner occupied. So that person has to live in the mobile home, just like in your homeowner world. It's very hard to find a mobile home policy that a company will write that is not owner occupied in the standard markets. Now, switching gears, we're going to talk about the personal umbrella liability. And what I like to do when we talk about personal umbrella liability is go to my white screen, and I'm going to talk to you about what a personal umbrella does here. So basically, when it comes to a personal umbrella policy, is you will have this umbrella policy that will have limits. Now, umbrella policies will start out at usually $1 million in liability limits. Again, an umbrella policy is just more liability coverage. Now, what is covered under this umbrella policy are two major coverages. And the first one is the personal auto liability policy. And then the other exposure would be your homeowner, and that would be your Section 2 that we've talked about. Now, what happens here is this is just an extra layer of umbrella. And the two things that you have to remember that umbrellas do is they do, and I've got all of this in this slide here. I'm just kind of going, giving an example here, is it's all about, let's go with higher limits first. It's all about higher limits, you know, higher liability limits. And it's also about broader coverages. Okay, so on your state test, you will say that these things here, this personal auto and this homeowner liability, these are called underlying coverages. Now, you don't need to memorize these underlying limits because every company is different, but most companies are going to make you carry really high liability limits. They're not going to let you do that 30, 60, 25 or that, you know, 25, 50, 25. They're going to make you go up pretty high. So again, you don't need to memorize this, but this is pretty accurate what most companies will do. Most of them will want you to raise that homeowner Section 2 liability to $300,000 versus $100,000. So again, when it comes to those limits there, those are actually called your underlying limits. Okay. Now, how does this work? So what will happen here is in each of the claim scenarios, and they'll tell you if it's covered or not, is you will always exhaust your underlying coverage limits first, and then the umbrella will pay the rest. So for example, if you have some type of auto claim, and let's say that the damages that are awarded to the claimant are, and we'll just make this, kind of crazy here. We'll say the damages that are awarded are $1 million. So what happens here, since this is an auto claim, is the auto liability policy will be maxed out at that 500,000 here. So the auto policy will pay the first 500,000, and then the umbrella has $1 million limit, so it's going to pay the rest of it. So the umbrella will pay the other 500,000. So that's how that works. Remember, you always exhaust that underlying limit first. Now, let's say that you have a homeowner claim. So maybe you invite a bunch of people over and your deck collapsed. And again, we'll just say the damages here, let's just say they're 500,000. So what happens here is the home policy, you totally exhaust that limit, which is 300,000. And then the umbrella pays the rest, which is 200,000. Okay, very simple to do. You'll exhaust the underlying and then bring the personal umbrella. It's an extra layer of liability. It's a separate policy that you'll write for the client. Now, there's also another part of the umbrella that's called the self-insured retention. Sometimes you'll see it called the SIR. It's a form of a deductible. And the deductible only plays in, and usually, again, you don't need to memorize this, but usually there'll be like $1,000. And what this does, this is where the broader coverages kicks in. So if the underlying coverages do not cover a claim, but the umbrella does, then the self-insured retention will come in. So you're not going to have to decide if it pays or not. It will tell you. So let's say a situation where there is no underlying coverage. Okay, so what happens there? Well, then the client will pay the SIR deductible, self-insured retention, and the client will pay $1,000. Okay, the insured, and then the umbrella will pay the rest. So let's say that there's no underlying coverage and we have some claim damages of 50,000. So again, these underlying policies say, nope, we're not paying for that, but the umbrella doesn't. So the insured will pay the first $1,000. And then, whoops, let's go back over here. And then the umbrella will pay the rest, which will be 49,000. So again, umbrellas do two things: higher limits and broader coverages. You're either going to exhaust one of these underlying and then the umbrella pays. And if either one of these do not pay, but the umbrella does, that's your broader coverages, then you'll exhaust your retention, your deductible self-insured retention, and then the umbrella will pay. So again, 3 different scenarios there, depending on what you have. One, the auto paid, one, the homeowner paid, and one, both of them didn't pay. So going back over here to your umbrella, your personal umbrella, the general nature is it covers the catastrophic liability exposures to personal risk. Umbrellas provide higher limits, and sometimes umbrella policies can provide broader coverages than the underlying limits. And what are your underlying coverages? Usually these are your personal auto liability and your homeowner liability. And before the umbrella policy will provide coverage, the policy limits applying to a loss under an underlying policy have to be exhausted first. I mean, they have to be totally exhausted, and then the umbrella comes down. Now, the only time you have a self-insured retention is when the umbrella has broader coverage and the loss is excluded under the underlying contract, but not the umbrella. And this is where the retention kicks in, and then the umbrella pays the rest. Okay, so friends, that ends the miscellaneous coverages for those. Keep in mind to keep studying, keep plugging away, keep repeating this information. Don't be fearful. How do you generate fears? When you sit, how do you overcome them? By action. One of my favorite quotes by Dr. Henry Link. So I'm going to come back to you guys here, turn on the video. So that concludes that part of the flood, the mobile home, your watercraft, and your personal umbrella. So I hope this tweaks this a little bit to help you understand these subjects. You usually have, 2, 3, 4 questions per subject. Again, maybe 8 to 10 questions in this real important part, but that's 8 to 10 questions you don't want to miss, right? So keep in mind, prepare means repetition, repeating things over and over again to yourself to give yourself some confidence. Okay, I'll see you in the next class.